Hello and welcome to a fresh new edition of Taking Stock. This is the show where we look back at the week which has gone by. We take stock of what really mattered, what did not, what influenced trade, and of course, more importantly, look ahead and prepare you for the coming week as well. We'll tell you what to pay attention to and how much. I'm Prashant Nair. With me, as always, on the show, Surabhi Upadhyay. Hi, Surabhi.
Hi, Prashant. Well, yes, interesting week. We've been creeping higher as far as the index level is concerned, but there's lots happening beneath the surface. And obviously, there's lots of stock-specific action that we will be talking to you about. So, in fact, before we introduce our guests on the show, let me quickly recap what we saw, some of the highlights of the week gone by. So, for the week as a whole, on the index, Sensex and Nifty, we are up 1%. So, that's the first point. Creeping higher is really what we can say, because the market now seems to be getting, the index at least seems to be getting very, very close to key resistance levels. We've been struggling at this 10,920, 950 zone for a long while. We've spent almost 2.5 months over here. And the question is, can the bulls break out? If this week was any evidence, we didn't seem to have the momentum in the bulls' favor. The reason for that also is the fact that the market is getting narrow. The rally, if you could call it that, is very, very narrow. What were the key pillars this time around? Reliance Industries, of course, a nice run-up before the earnings, and then after the earnings, a strong performance on Friday. So that's one of the biggest plus factors for the indices. The other pillar or the other pocket that's working is IT. Specifically after, of course, Infosys' performance, there was a lot of weight being added in over there as well. So TCS, Infosys, Wipro, most of these stocks have put on a nice gain between 5 and 7% for the week gone by. But what's happening beyond that? And Prashant, for me, this was very interesting to note. The market's most loved trade of the moment, corporate banks, there the rally stalled. So ICICI Bank, Axis, State Bank of India, these stocks have not had a great week. So that's an interesting trend to perhaps keep in mind. And finally, of course, talking about the mid-cap action, the market's been a little sluggish here. The mid-cap index is underperforming. That's not just a trend for this week, it's a trend for this month. And that continues unabated as well. Last but not the least, speaking of underperformance, it is underperformance for India as a whole. Let's just get the MSCI indices, the Dow, and some of the other global markets up for you as well, because for the week, MSCI India is up less than 0.5%. If you're looking at MSCI Asia ex Japan, those indices have done much, much better. And even when we shut, the Dow in the 4 trading sessions itself had put on more weight than us, 1.5% in just 4 days alone on the Dow, as well as some of the key European markets. So underperformance is also something that's a bit of a hallmark. So I don't know, Prashant, though the level is sort of getting back, creeping to 11,000, but I don't know if the conviction is there.
But I think, Surabhi, what you started by saying, which is that the market is narrowing, is very apt. I think, there was this data that we put out earlier and somebody had sent it to me. And this person looked at 1,500 of the most liquid stocks in the market. And he found that there are only about 82% of those stocks are below their respective 200-day moving averages. And some are sharply below, and you could disaggregate the numbers and get that as well. But, I mean, the fact is that pockets of strength are thinning out. And you mentioned corporate banks. I mean, there was Reliance to help today. But, I mean, generally speaking, not too many legs to stand on in that sense. I'm not talking about all of the market. I mean, even if you look at the index, the Nifty 50 stocks, there also you don't find too much. But anyway, let's just look at all of this in a top-down fashion. We are in the middle of the earnings season, so I'm not really going to touch upon, what companies will report numbers tomorrow, because, I mean, a reaction will depend on the performance. But let's just tell you the themes which are going to matter. I think the risk sentiment, generally speaking, I'm talking about global markets, etc., the risk sentiment still seems pretty robust. And this is despite very clear evidence now that at the margin, incremental data is showing that global growth has slowed down, is in the process of slowing down. But despite that, sentiment is not bad. You look at the US specifically, the incremental data, I mean, some of it is strong, but some of it is also showing that things are weakening a little bit. But the fact is that data is at the margin weakening. It's not terrible. That is an important difference. As a consequence of that, we've got the Fed, which is still actually pretty dovish. We've heard from, 15 Fed speakers over the last 15 days, 20 days. And, I mean, generally, the common thread is that we will remain not accommodative, but, I mean, there is no decision already made that rates are going up. We'll decide according to the data which we are actually getting. And some of it actually has been completely straightforward dovish. What has the US market done? In 2019 so far, there have been only 3 down days for the S&P 500, right? I mean, so, and that's the reason I'm saying that generally speaking, across the board, sentiment is not bad at all. Then you come to China. You had overnight, and as we close the week out, this report in the Wall Street Journal said it detailed, it actually brought forth, things which, and I think markets reacted to around the world on Friday in a positive way. And what that report showed is that the talks between US and China and relations generally between US and China are not as bad as what the market actually assumed it to be. Will the market be able to continue to rally on the back of that? That remains to be seen. But it was taken note of very, very well. In China, what is happening? We're seeing, almost every second day, new announcements of some sort of stimulus, both on the monetary side and now expectations that there could be something coming on the fiscal side as well. So, I would say that it's the overall just going by prices. And if prices were reflective of sentiment, the sentiment is, the global sentiment is still pretty constructive and supportive. Even as you said, though we might be heading to and getting to some resistances, not just in India, but around the world as well.
You spoke of stimulus, and I think that's a really interesting word even for us here in India, because at the India Business Leader Awards, the finance minister did give a hint that maybe if it is really required for certain sections, largely was hinting at the agri section, then maybe even fiscal deficit limits might have to be breached for just that little bit. Anyway, let's take this conversation forward now. Joining us to discuss the week gone by and more on the Lal Street is Ashwini Agrawal, co-founder and partner of Ashmore Investment Management. Ashwini, great to have you back in our studios.
Thank you so much.
Now, we've outlined a lot of these factors that are playing on most people's minds, whether investors or traders. Let me ask you this. Is this market struggling at 10,900? Is it giving you a bit of an uncomfortable or an eerie feeling? Or do you think this is healthy consolidation? It's par for the course, and it's just a matter of time before the charge goes higher.
So, see, we've come a long way since about the 10th or 11th of December when the market bottomed out. The broad market is up about 10% since then, and small caps have given a similar type of return from there. So it's a very broad-based rally in spite of the bad news that we received around the 10th and 11th of December, which was the resignation of Dr. Urjit Patel, followed by the political results of the key state elections. And the market actually rallied very strongly after that. It outperformed the entire emerging market space. So my sense is that in the short run, the market was probably braced for a lot of bad news. And sell the rumor, buy the news kind of played out. Where in December we saw a significant amount of rally. In January, what we are seeing is a narrowing of that rally. So I think the market is digesting some of the gains that it made in December, waiting for the earnings reports to come through. Early part of the earnings season is predictably strong. That tends to be the case, barring IT companies that typically report early and good or bad. The early part of the earnings season typically tends to be healthy, and that's what we are seeing at this point in time. So my sense is that the direction of the market, at least in the near term from here, will be determined by how the earnings outcome is before the political noise starts to become more visible starting in the middle of Feb or thereabouts. But having said this, short term, one doesn't really know what happens and what drives the markets.
Ashwini, there's a week to go for the budget as well, right?
Yes.
So a lot of although it's a vote on account, so
yes.
There's limitation, etc. But what's the market really building in?
I don't think the market is really expecting much from the budget, Prashant. I think what people are really waiting to see is what is the fiscal deficit number, because that will be higher than the target. But is it, 3.5, 3.6? What is that number? What does the government propose to do? I think those issues are important. And as the finance minister spoke, in yesterday's televised interview, there may be something that the government announces to provide some relief to the agricultural rural economy, which is where we see a lot of stress. So that might be the only thing that one can see. Otherwise, it's a vote on account budget. They can't really propose any significant fiscal policy measures through the budget. I think the opposition would not take kindly to that. So I'm not really expecting anything much. The finance
minister also said that, if it's an extraordinary situation and we announce something, I'm sure the market will understand. My question to you is, will it?
I don't know what it is. So, it's a very open-ended statement from his end. So I don't know what he's proposing, what he's speaking about. I really can't imagine, what the market will take kindly to.
But 3.5.
No, but yeah, can it digest 3.5?
Yeah.
I think it can. I think the bond markets might see a little bit of a wobble, but I personally have not been a huge fan of these very strict fiscal targets. I think in the case of emerging market economies, a little bit of fiscal leeway, especially in difficult times, is warranted. So I personally wouldn't really be bothered if the fiscal deficit number is 20 basis points higher or 20 basis points lower than a number out there. I mean, are we being fiscally irresponsible is the question to ask. And I think it's the first year of GST implementation. It is very reasonable to expect that the revenue numbers will not be what the administration might have imagined them to be. And I think if the fiscal number is a little bit higher than what it was meant to be at the start of the fiscal year, is fine. It's not a big deal. I think on the contrary, as Mr. Kotak suggested on the IBLA award show yesterday, I mean, there is a need for a monetary stimulus at this point in time. Real rates are very high. So I think room for fiscal deficit is difficult, but I think room for monetary stimulus is there, and I wouldn't personally worry too much if the fiscal deficit is a little higher. So
since the voices asking for stimulus on both fronts, I mean, on the fiscal side and the monetary side, they seem to be growing louder. Now, if at all, if the RBI does oblige in the months to come, February, I mean, if we start getting some rate cuts, and with this farm package or some sort of rural package that's likely to come before the elections, then are we really asking for a big takeoff in the market? And in that context, where does one place consumer stocks? I'll tell you why I'm asking this. Look at the reaction to HUL's numbers. Very interesting. Fantastic numbers, 10% volume growth. The stock doesn't move.
Right.
Because suddenly the market seems to have woken up to the reality of high valuation, something we're all forgotten. So in that context, how do you interpret this?
So, Surabhi, great question. We've been value investors, and we haven't understood the valuations that have been paid for some of these stocks for a while. We've seen a significant correction in some of the very, very loved names in the last month and a half. We've also seen a comeback in value stocks, I mean, the corporate banks, for example, where I think confidence is now starting to build up that all the bad news is in the price. We should look forward to a better future. To my mind, what was happening over the last 2 years or so was that growth was so scarce that wherever you found a little bit of growth, you were willing to pay for that, irrespective of how much you were paying for that. And I think we might be getting closer to a more normalized cycle. In addition to more normalized earnings cycle, in addition to what you mentioned, I think the two factors that I would like to watch out for is normalization of NBFC finances, because they are big lenders in the market, especially in the MSME space, and they drive a lot of the business cash flow. I think normalizing of that cycle is extremely important. And the second one, where personally, I don't know what to predict. I've been disappointed with the pace of resolutions at NCLT. And I think we need to see some of that capital come in. I mean, there is a very large bid for SR Steel out there. I mean, we are doing ourselves a disservice as a nation if that money doesn't come in quickly enough. Because that resolution of that asset, bringing in that foreign exchange, will improve the liquidity, will allow an asset to go off the bank's books. It's all good stuff, but it's not come through, and that's what we need to see for the next leg of big up cycle.
So just to flip that question on consumers on the opposite side, if growth in other earnings growth is picking up elsewhere, and expectations are that it will pick up, so people have more options and they don't have to hide in consumers. Could it undergo a large period of underperformance? Like, for example, HUL, I think from 2000 to 2010 did not do anything, 10 years, right? I mean,
it's very possible. It's very possible. I mean, if you just plot PE ratios of some of these consumer companies going back, 10 years, 15 years, 20 years, they are trading well above one standard deviation numbers for a very long history. And growth rates are not spectacular. I mean, they're not bad, but you're growing at what, 11%, 12%, 15%, somewhere of thereabouts. I mean, to pay 60x earnings just doesn't add up in terms of, any dividend discount model or any sort of a, cost of capital model. So I don't know why these stocks are so expensive. Maybe they were great places to hide when the economy was going through a bad time. If things do indeed normalize, I think investors will have many more options.
So what do you buy? You're saying can't buy consumer, shouldn't buy consumer perhaps because they're just way too expensive over the top. There is an argument about the so-called green shoots, whether cyclicals will really sort of pick up or not. I mean, I've been hearing a lot of feedback saying at least for the next 2 quarters odd, expect order books to slow down a bit because generally ordering will diminish before elections and the new government comes in and things settle. On cyclicals, I mean, are you convinced? Would you buy something there?
So if you look at the corporate bank NPA cycle, or even I would include the PSU banks to some degree, I think there is a palpable improvement there. I mean, there's a confidence that we sense when we speak to the managers of these banks is reasonably high. If I compare that to about, say, 24 months ago or 12 months ago, there was a lot of uncertainty in the commentary. Today, there's very little uncertainty in the commentary. Incremental slippage data, which is available to us for the last few quarters, is showing you that the stress is decreasing. So that's clearly an area where investors can look for ideas. I think even in automobiles, if the NBFC financing normalizes, we should see some improvement because a lot of the automobile sales at the end of the day are financed, and it's not just the consumer, the whole supply chain. Okay, the dealer financing, the supplier financing, all of that involves NBFCs, and I think that shock which the system has seen over October, November, December should normalize as we go into the next 3 to 6 months. So my sense is that yes, domestic cyclicals we should be okay. I don't see too much of a problem. I see some headwinds. I think the government capex, which has been a big driver for the last 2 years, will slow down. I think the fiscal deficit is on the higher side, and I think the government may not have much option but to direct its resources into rural India rather than continuing the capex binge that they've been on. So we are seeing some signs of private sector capex pick up. But the nature and the quantum of that capex is going to be very different. So the people that benefit from that capex are going to be very different. So that, I think, allocation change, in stock picking,
we should be right back to consumer staples then.
No, not really.
Not really. Happen.
No, but then who are these people who are going to benefit? The private sector capex recovery, because it is, in micro pockets, you need to pick and choose carefully. Now, you're not going to tell us stocks. We know that. So, but at least give us a hint. Who benefits?
So machinery makers, people doing equipment, people doing process equipment, stuff of that nature.
Industrial goods, you're saying?
Industrial goods. Okay. I mean that will benefit. I mean, again, if you think about it, that you're saying that the whole world is slowing down, US is slowing down, China is slowing down. So we can't really expect a massive, increase in crude oil prices. Oil marketing companies are as cheap as they've been before deregulation came into being. So, what's wrong with them? I don't see anything wrong with them. You go down the market cap curve, go to companies which are less than $2 billion in size. They are extremely attractive on pricing. On the same PE ratios, draw back the charts on historical numbers. I'm not saying you do your forecast. Just take the last 4-quarter earnings numbers, plot the PE ratios, go back as many years as you can. Most of them are trading at well below median. A lot of them are trading 1 standard deviation below long-term averages. So I think there's a lot of value there.
Do autos have a demand problem, though? You said liquidity, but is there a demand problem or no?
There is a demand problem for the reason that financing is not available.
Independent of that.
It's hard to judge. See, there is rural distress because food prices are low and input prices have increased. So there is obviously rural distress. So there could be an element of demand which is soft due to the rural distress, but there is also a financing shock that the system has received. Sure. So how much of it, which is what I can't tell.
Last one, Sun Pharma. We have to talk about that, don't we? I mean, what do you make of it, the entire issue, without going into whether you should buy? I mean, I'm not asking for investment advice here, but what's the way to think about it?
So I think there's very little information for anybody to take a call on the particular name. And I don't want to say more than that because a lot of it is, part information, part innuendo, part rumor. We don't know what the document looks like in its entirety. I think it's a very, very tricky situation even for the regulator or for the company. The company believes that they haven't been sent a copy of the document, so they have no idea what the document contains. I think the regulator needs to step in, ask the company to clarify what's in the document, and we need to get to a bottom of this because this kind of, rumor mill based noise is hurting everyone. I can't really say anything beyond that because I don't know what's in the document and I can't verify whether it's true or false.
You know, you are an institutional investor. You can at least go to this publications office apparently and seek more information. With the average retail investor, I mean, you just sit back, watch the drama unfold and hope your stock price recovers at some point.
Which is why I think the regulator should step in and ask the company to comment on the document and provide the company with a copy of the document if the company doesn't have it.
All right, Ashwini, thank you so much for dropping in this week and having this conversation with us. We'll see you again shortly. We need to take a very quick break. As we do that, let's listen to some more market opinion that we gathered during the course of the week. When we come back, technicals with Ashwini Gujaral.
We don't see a time correction because it's very bad for people like us. We want markets to have direction. We want markets to have volatility. And actually, if you look at the history of markets, you've rarely seen periods where markets remain flat. Right? You always see some expectation cycle up, down or the other. And my worry is that you will see a direction downwards. So we've said that in the first half we expect equities in aggregate India to be down. But we are hoping that second half of the year, when the global central banks sort themselves out, we'll see some stability to prices. But at least in the near term, we think that there can be significant downside.
The way we look at it, I think the 3 C's, crude, currency and cash, I think with these 3 factors having stabilized really well for Indian equities, I think the time has come for Indian markets to, start doing much better than what we've seen in the last many months. The market has been fed with a lot of negative news in the last 6 weeks, and despite all the ammunition, we were able to hold on to that important support of 10,400.
Welcome back. You are watching Taking Stock. Joining us now is Ashwini Gujaral with his view on the market. Ashwini, your assessment 1% higher on the index. How does it add up?
Well, while we did close, almost where we opened for the week, the issue is that the market is narrowing a lot. I mean, Reliance can't go up 4% on a daily basis. So basically, the market is narrowing. 3, 4, 5 stocks are taking it higher. Only the large caps are moving up. And if you see market breadth, it was 1:3 in favor of declines. Mid-cap indices were all down and substantially down. So that way, the market is losing momentum. This is what you call by losing momentum, when very few stocks are supporting an up move. This generally tends to happen, at key levels. So somewhere, particularly on financials, this is more evident. So basically, it's Reliance and IT on one side, and the rest of the market, mid caps, banks, etc., everything is tending to give up the gains. So this will be confirmed below 10,850, and then maybe a larger trend may be available. Till then, you have result season, etc. As far as I am concerned, today's results could not make fresh highs. So somewhere, the market is looking beyond the results. So that way, once 10,850 is taken out, you should move lower. But till then, choppiness will continue.
Okay, choppiness will continue. Ashwini, so, in terms of identifying strong and weak pockets in the market, what would those be, and what would you do in terms of trades, stocks?
See, the stronger pockets are basically Reliance, Kotak Mahindra, etc. But all of a sudden, accidents are beginning to happen. Sun Pharma, obviously, everybody knows. But something like Bharti fell because of Reliance results, and fell much more than Reliance went up, actually. So this is a sell with a stop of 315, target of 300. Sun TV is making new lows for some reason. So that's a sell with a stop of 526, target of 500. And Reliance, I think, is in a fairly strong trend, and any sort of decline should be bought. This is a buy with a stop of 1150. Look for targets of 1210.
Okay, Ashwini, thanks for those trading ideas. Well, with that, we come to the end of this edition of Taking Stock. That's it from Prashant and me. We'll see you with the markets again on Monday morning. Thank you for watching.